Welcome to the Advisors Fuel podcast, where high-performing financial planners and wealth advisors discover proven processes and actionable strategies to elevate their client experience, grow their businesses faster, and achieve unprecedented success. Here's your host, Adam Koós, founder at Adrenaline Advisor Consulting at adrenalineadvisor.com.
All right, today on the Advisors Fuel podcast, we're joined by John Kosar, a market strategist with over 40 years of experience in technical analysis. As the chief market strategist and founder of Asbury Research, John's built proprietary models that help financial professionals make smarter investment decisions. We're going to be talking a lot about that today. Then we have Jack Kosar. He's vice president investment strategy at Asbury Research, and he brings a strong quantitative approach, kind of a different angle to portfolio management with a master's in finance and experience as an analyst at Symetra and Allview Systems. Together, they lead Asbury Research, providing data-driven insights that help advisors navigate market trends with confidence. Their expertise has been featured on CNBC, Bloomberg, the Wall Street Journal. They're on multiple webinars with Fidelity, Schwab. So they're very much trusted voices in the investment industry. Let's just say that. And beyond finance, they each bring their unique passions. John with his deep market experience, and Jack with his enthusiasm for coaching youth baseball, weightlifting, and grilling. So do not mess with him. So John and Jack, welcome to the show.
Great to be here, Adam.
So the reason why I wanted to do this with the two of you is that as part of Adrenaline, and when I'm speaking on stage or doing webinars for financial advisors, a question that often comes up is they want to talk to me about portfolio management because they know I'm a certified market technician. You're certified market technicians. They know that I use technical analysis and relative strength to manage portfolios. But as we have talked offline, I have no interest whatsoever in taking, at least for the foreseeable future, taking my models that I've built for our clients and making them available to advisors around the country. Because full disclosure, the three of us own a company together, which is Asbury Research, powered by Libertas. We have models that are managed by Asbury and Libertas on TAMPs, on SMAs through Charles Schwab. So it is much more turnkey, I think, for them to add that exposure to technical analysis, trend following, risk management through these SMAs rather than to try and reinvent the wheel. So oftentimes I'll be telling them about you two and what we've built together over this last year, which, I can't believe it's been a year already. But we're growing fast. A lot of advisors are adding client assets to our models. And so I just wanted to do this podcast to kind of let them in behind the scenes, behind the metaphorical beaded curtain, and talk a little bit about what is technical analysis, what's the story in the case of Asbury Research, what are we building here for financial advisors, or I should say, what have we built? What do those models look like? And really, how can they incorporate more risk management into their portfolios to save their clients from catastrophic market downturns, especially at times like we're living in right now, frankly, where things are crazy on the news, people are freaking out. And that happens all the time, right? The market goes down 5% on average 3 times a year, goes down 10 to 15% on average once every 12 to 18 months. And that's normal. But that doesn't change the fact that people freak out. And then once every we'll call it 3 to 4 years, the market goes down 20% or more. And that's where things get really scary. And especially your clients who are taking money out of their portfolios and taking systematic withdrawals, they can't afford to see another 2007, 8, 9, or 2000, 2001, 2002, or some of them even a 2022. And then COVID obviously wasn't any fun either. So let's start with just hearing the story about the origin of Asbury Research, going back 40 years and kind of what inspired, its founding.
Yeah, sure. My career started in 1980 on the floor of the Chicago Mercantile Exchange. Started as a runner, knowing absolutely nothing about financial markets except that you can go there to make a lot of money. I mean, my goal, the initial goal was just to, as a young man, to learn a trade where I'd have the opportunity to be successful. And so I spent 17 years there. And so my exposure to markets is really less academic and a lot more practical. The guys that trade on the floor every day are really concerned about how much they're risking. They don't come in there. Let's put it this way. The ones that come in there with big eyes and all they think of is how much money they can make, you don't see them there for very long. A couple of quarters go by and they would be gone. And so you learn pretty quick that the market has an inherent upward bias And the way that you make money in the markets is by avoiding the drawdown. So that was kind of where I started. We launched Asbury in '05. And so my piece of this is doing this for 40 years, having a lot of favorite indicators that Jack and I have built in the models. Jack brings the the academia part of this, being able to take my experience, quantify it, and find those indicators that have the best back-tested results. And we have created numerous models and portfolios out of those.
Awesome. And Asbury 6. Actually, you know what? First, let's talk about just the data-driven approach, period, because I think that's really important. It's not emotionally driven. It's not news-driven. It's data. It's objective. So talk about your research, how it emphasizes a data-driven approach, and maybe elaborate a little bit more on those key metrics and indicators that you two are prioritizing in that analysis.
Yeah, I'm kind of a reformed seat of the pants trader. From being at the Mercantile Exchange all those years, I found that I wasn't a very good trader in the pit because of all the emotion there and all of the testosterone and chest bumping that goes on there. I didn't do well in that environment. And I found that I was a better trader. I made better decisions and I slept better by letting the data tell me what to do rather than getting swept up in the emotions of trading, which I think most individual investors do that. And that's where they have problems. The reason investor sentiment works is because when everyone's bullish, the market tops, right? When everyone's bearish, the market finds a bottom. So that's kind of how I ended up on this tack. And I think it's the right tack. I think you make more money and I think you live longer. The the amount of anxiety is much, much less. And your clients really appreciate it. Like we've been risk off now for about a month. And our clients are writing songs about us right now because we've avoided this downtrend.
Yeah. Two things. One, the sentiment thing you mentioned made me think of the Baron Rothschild quote, where, you buy when there's blood in the streets, even if it's your own. And then, yeah, I'm glad you brought up that the CPM model, which we'll talk about in a second here, but one of the portfolio models, CPM capital protection model, has been in 100% cash, for a few weeks now, I think.
February 24th, I think was the day.
24th, yeah. So, Jack, can you maybe speak a little bit to the quantifiable, back testing side of this? And you don't have to get into back test. I don't think we want to do that, but maybe talk a little bit about the quantified side, about the data approach, from your angle.
Yeah, no, absolutely. So I think a lot of times when you're, especially with technical analysis, you end up staring at the chart a lot. And when you stare at those charts long enough, you end up sometimes seeing things that are either not there, or you can filter out, your brain filters out the things that maybe you want to ignore. So you look at an indicator, you see it on the chart, and it's a world beater. You're gonna beat the world. You're gonna make more money than you've ever made before. And what I came in to do is we wanted to systematize everything. So not just look at the indicator on the chart, but understand the different components of that indicator. So we look at Sharpe ratios, we look at returns. These are all historical, they're back tested. But we just want to see how those indicators really react to the market in a more data-driven approach. And then when we're putting those indicators together, we speak in metaphor. So I think of it as putting a baseball team together. So I might have an indicator that's going to drive alpha. We're really a driven or really return-driven type indicator, but it might not be so great on the defensive side. And then I'll bring in another indicator that's really good at reducing drawdowns. And we kind of build from the base up this baseball team of indicators. Some guys are going to get on base, some guys are going to drive in the hits or drive in the runs, and taking that just the eyeball approach and really putting some numbers behind it so that we know that when we're using indicators, not only do they look good, but they test well as well.
I love that you're using analogies already, because I know we always talk about how when we all first met a couple years ago, how we both find ourselves using metaphors and analogies constantly. But it's the best way for people to learn things. And honestly, for the advisors that are watching and listening, it's the best way for them to teach this to their clients, because they don't understand this stuff.
You need to explain it in a way for something that's relevant to them, so they understand it. jargon does not work well in this business. Equating what investing is to something that they know really helps.
For sure, yeah. So let's talk about the Asbury 6. If people go to www.asburyresearch.com, you can look this up. But the Asbury 6 is what I would call a barometer. I know you probably call it something different. So let's just say it's a barometer for the market that assesses the market's internal health using different metrics. I like to think of it, we think PET scan, CT scan, these different, X-rays. Can you break down these metrics and maybe explain how they collectively guide investment decisions?
Sure. The genesis of it was, I would say, within the past 10 years, and those that have been in the market for a while know this, as there was more and more computerized trading, more and more algorithmic trading, everything sped up. You saw a lot more day-to-day volatility than you used to see. We've really seen it here so far this year, where you might have the S&P 500 up 100 on a Thursday and down 100 on a Friday. And it started throwing me off my game. I was looking too closely at the S&P 500, and the markets run up and down through a lot of different levels that people may think are important. So I built the first version of the Asbury 6 internally. I took 6 disparate indicators, and we've got volatility in there. We have relative performance. We have market breadth. We have asset flows and a couple of others. So rather than chasing the tail of the S&P 500 every day and throwing myself off sides, I was looking at these, let's call them secondary metrics, to see how afraid is the market? Is there a lot of market breadth? Is there a lot of participation here, or is it just a handful of stocks? Is there money moving in or out of the market? And what those allowed me to do was not get knocked off of my game because there was a volatile week. It helped me personally to do a better job for my clients. And then Jack came in and back tested all those metrics, and we really fine-tuned them in terms of what they do. And now it's probably our most viewed. Our clients are trained, the research side, are trained to look at that every day. So they have a much more objective, day-to-day understanding of what's going on in the market, and not some of the gymnastics that we've been seeing day-to-day.
Yeah, gymnastics is a good word. Portfolio management, I think, in the financial advisory world, I think has kind of become, for most of the industry, a commodity. I think that in order to differentiate yourself, you really have to do things different, whether that's through a buy and hold model, and how the buy and hold model is managed, or if it's through a risk management model, whether that's trend following or what have you. Let's start, because I want to talk about the models here, but we don't have to talk about all of them, but I want to highlight kind of from a high level, the different models we recently launched. But let's start with SEAF and how it focuses on sector rotation, tracking asset flows across various sectors, rotating out of weakness into strength, staying with strength, essentially. So could one of you maybe discuss about kind of how SEAF, it's SEAF, by the way, SEAF, how this model identifies opportunities and its role in portfolio management, or how you see it as fitting into the big picture?
Yeah, no, absolutely. So our SEAF model, what it does is it tracks the velocity money over 3 time periods for the 11 sector spiders. So the 11 sector spiders, if you don't know, it's the breakdown. Basically, if you divide the S&P 500 into its various components, you have energy, technology, utilities. There's 11 of them. We're tracking the velocity of money. The model itself takes the top 3. We give a ranking score. It takes the top 3 and is always invested in the market. So we often get, hey, your other models say we're risk off. Why are you still invested in SEAF? The idea is that a lot of managers, as you guys may know, have to be invested in the market at some point in time. So we view the 11 sector spiders as a universe and kind of contract the money flows going between the different sectors. Oftentimes we will see money flow into one sector and see a reciprocal move out of another sector. So it's kind of this push me, pull you situation in SEAF. The way SEAF kind of gets applied to a broader portfolio, we've actually just recently ran the numbers. There's a 70% correlation in SEAF in its returns to the market. So it allows for you to still get outsized gains while not exactly moving in the same direction of the market. Otherwise, if it was perfectly correlated, there would be no differentiation between buying the S&P 500 or buying SEAF. So SEAF, what it allows you to do historically, has outperformed the market by, was it 7 or 8%?
About 7.5% annualized since the middle of 2018.
Yeah. So what it allows you to do historically, obviously, we're not projecting anything out of the future, and
Of course,
future or previous gains are not future gains guaranteed. But it allows you to, in general, outperform the market by selecting the sectors that are seeing a lot of that money flow into them at one time.
And one of the great things about SEAF too, even though it's an alpha generator, is how we see it. If you look at the defensive numbers, the standard deviation, the maximum drawdown, the beta, all of those since that 2018 start date, slightly less than the S&P 500. So we're really not taking on any additional exposure, any additional risk for this, the outperformance that we've been able to get out of the model.
the analogy I always like to use with models like the SEAF is it's like if you looked at every investment that you could buy as every team in March Madness that's in the bracket. What we're doing is we're buying the one seeds. We're just buying the top seeded teams because the probabilities are not that all of them are going to win the national championship or the March Madness bracket, but they're going to be towards the top. And at the end of we can't predict the winner, but we can get pretty close, and we can definitely, what was it until a couple of years ago, a 16th seeded team had never won a game, not the tournament, hadn't won a game. So it's staying invested with those top seeded teams or the highly ranked teams or the playoff teams, whatever you want to call it, and avoiding the rest. So whereas I think for a lot of advisors, I think we're used to like the buy and hold model where you're just kind of statically invested in different style boxes. Maybe, there's static allocations, there's funds of funds, things like that. So I think that, I'm obviously biased. I love technical analysis and relative strength. So I think this is kind of a better way, in my opinion, to get access to the market and stay in the market by staying invested with strength, staying invested in those playoff teams. Now, one of the things you mentioned a second ago, Jack, was risk off. And whenever we talk about that, I think that not everybody knows what that means. So first off, so everybody understands what risk on and risk off mean. It means basically at risk or not at risk, meaning you're in the market or you're not in the market, or you're invested in an index or you're not invested. You're risk off, you're in cash, money market, if you will. So there's another model that was kind of one of the foundations of Asbury Research called the correction protection model, or CPM for short, which the whole function of this model, it's different, very different from SEAF, where the whole point is to shield investors during market downtrends. And we're recording this on Thursday, March 20th of 2025. So market downtrends, just like the one we're in right now. And what differentiates it from traditional risk management strategies is what?
So, yeah, the genesis of CPM was after about mid to latter part of 2008. We had a number of clients who didn't know each other, all kind of asked me the same question over a 6-month period. Can you build us a simple model that tells us very simply in binary, should I be in stocks or should I be out of stocks? Because what happened to a lot of their clients is once the financial, the crisis started in 2007, they stayed too long. And you go through these like 3 or 4 different periods. First of all, I still have a lead, so it's okay. And then it's, well, I'm pretty much even from where I bought it. And then it's, well, I'm only losing a little bit. And then it's, oh my God, I can't take a loss down here, right? So you go through what do they call that? The 4, I'm talking
investment.
4 stages of grief is what that is.
Right.
So what happened to a lot of these people is they got out near the bottom. They couldn't take it anymore. It's like, I'll never trade stocks again. And then the market bottomed, secondary bottom in March of 2008, when we started to rescue the car industry, the auto industry. And the market went up. And now these people were deer in the headlights. They just got traumatized on the way down. And they didn't have the sense or guts or whatever it is to get back in the market because they just got their heads handed to them. So we built a model that doesn't trade very much, and it's binary. It goes from risk on to risk off. So how we trade this as a portfolio is it's like a dynamic stock bond allocation, only we're letting the market tell us whether we should be in stocks or bonds. So when we're in it, historically going back to 2017, annualized trades a little less than 5 times a year, so a little bit more than once a quarter. And when we're risk on, we are in SPY. And when the internals of the model tell us the market is getting weak, we shift over to BIL, ticker BIL, which is a short-term interest rate based 1 to 3 month treasury bill ETF. And we go back and forth between those two. So like we had mentioned earlier, well, basically what the model has done since inception is it's stayed right with the S&P 500. But during that time, maximum drawdown for the S&P 500 was 34%. That was during COVID. Mm-hmm. Maximum drawdown for the model is 20%. And the standard deviation is considerably lower, which just means that your client's P&L is going to be less jumpy, which makes them more calm.
Yeah. If I could chime in and say that what this type of model does, I think, for people is 2 things. One, it adds some peace of mind when the clients call and they're like, hey, what's going on? What are we doing? I'm watching the news. Things are crazy. You're like, well, a portion of our portfolio is actually in cash. We're taking some measures to protect the money. And that's if this model makes sense for the client in question, right? The second thing it does, which I think is almost more important, I always like to tell this story, like paint a picture here. Clients retired taking money out of their portfolio, 5% withdrawal rate, $1 million portfolio. So follow the math. 5% withdrawal rate on $1 million is $50,000 a year. Market goes down on average 42%, depending on the time frame you're looking at. That's the average crash. We'll just call it 40%. That makes numbers easy. Average crash about 16 to 18 months. We're just going to say 2 years. Again, make it easy. If it were like 2000, 2001, 2002 again. So if we have a 5% withdrawal rate at $50,000 per year and the average crash is 2 years, that's $100,000 we've taken out of the portfolio, 50 and 50, right? Year 1, year 2. If the market goes down 40% on average and we're in stocks, we've just lost $400,000, just keeping numbers simple. What's left is $500,000. You might think, well, okay, we still have $500,000 yet, but here's the problem. Now the withdrawal rate's 10%, and our break even net after fees and taxes and any other expenses drift, our break even is 10% per year. It's going to be really, really tough to see that client recapture that asset and see that $500,000 ever touch $1 million again, which is why technical analysis, trend following, risk management is so important, not for all your portfolio, but I think it's really important for a portion of some clients' portfolios. I got to be careful what I say here. I'm obviously a little bit biased, but I think it's a great way to manage money. Now, like I said earlier, I don't want to get into all the models. One of the things that I've been most excited about this past year is the launch of the model portfolios. So there, aside from CEIF and CPM, the inside of these new models, CEIF exists, CPM exists to a certain percentage. You've got an aggressive model now. We have a balanced model. We have a conservative model. And then we have an ultra conservative model, maybe for those clients that are taking withdrawals, they're scared to death in the market. So there's 4 different model portfolios now that advisors can use or put a portion of their clients' money into 1 or 2 of those models, depending on what the goal is or the objective for the client or their financial plan output or what have you. So you develop these blended portfolios. How do these blended strategies enhance the risk adjustment and returns above and beyond CPM and CEIF?
Jack's had a huge role in actually building this. We're going to let him take that one.
Yeah. So what we wanted to do, we wanted to make it easy for advisors and our other investors to understand, the question is, you guys got great models. How do you deploy them, right? So we wanted to build out the 4 different model portfolios to allow them to kind of take their clientele, have it broken down into the different risk profiles, and know how to use our models in their portfolio. The way we see it is Asbury Research is a sleeve in an investor's portfolio. The way we look at it is we allow them to diversify their strategies. So they're going to have multiple strategies in their account. One of the sleeves should be Asbury Research, in the sense that we do a real good job of having a drawdown reduction. You can take a more aggressive strategy as for a part of your other part of your portfolio. And if you blend it with Asbury's models, you have some downside for that particular sleeve. So we have our ultra conservative, which historically has never had a drawdown greater than, I think it's 9.5%. Mm-hmm. And if you have part of your portfolio in there, that's a safe amount of money. That money is not going to grow at the speed as maybe an alpha generating type model, but that money is going to retain its principal with using its historical backgrounds. So we just really wanted to make sure that really there was a model for every type of investor, and then subsequently an investor can then slice a part of their portfolio and take one of our models and kind of slide it in there using its risk metrics.
So ultra, he had mentioned the ultra conservative model. That one, we have 5-year look backs on these. So again, a very small drawdown. We've had people call us and say, I need to be in equities, but I'm scared to death. I'm really afraid to take a big hit. Is there, do you have something where I could limit my drawdown to 10%? That was really the genesis of this. Mm-hmm. And then Jack started plugging in different pieces of our models and different indicators. And on a 5-year look back, I think that what is it, trailed the S&P by about 3 or 3.5%.
Yep.
Look back at 5 years. The look back on 3 years is about the same. So it underperforms. But if the S&P over the past 5 years, I think the annualized is somewhere in the 12% neighborhood. So this would be 3% or and change less than that. But on the flip side of that, it's never drawn down any more than 9%. So for a lot of investors, this is a really good piece that helps them to sleep better at night.
Yeah, try to maximize up capture to a certain extent, but minimize down capture. And
yes.
So the aggressive model is like for the clients that are younger, they've got lots of runway ahead of them, or it's a piece of their portfolio they want to be aggressive with and try to shoot the lights out. Balance is probably going to be the middle of the Gaussian bell curve. It's going to be a lot of people, I think. Same with the conservative model. The ultra conservative model, in my opinion, is probably going to be more for those clients that are in their distribution phase of life, where they're supplementing their pension, Social Security, or both with systematic withdrawals from their portfolio, and they don't want to go through that sequence of returns problem, that little math equation I did a second ago. They just can't, because they don't have the time to earn it back. And I mean, how many times as advisors, how many times have I heard that from clients? Like, look, I don't have the time to earn it back, so I want to make money, but I want to protect it. So speaking
it's
of,
like playing football in the fourth quarter, right? You play football in the fourth quarter differently than you do in the first half, because if you have a lead, you want to run out the clock, so to speak. And if you can score again, but you're not taking any chances. And I think investing is very much like that. And a lot of our clients are either approaching retirement or they're in retirement. And that's how I explain to them how the game changes.
Yep.
It's the same game, but you don't play it the same way when you are in the latter part.
It's a great analogy. And just because we're recording this in the middle of, one of those kind of nasty corrections, I've been talking to our clients a lot about how a year ago, a similar drawdown took place, but the only real difference is what's on the news. But still, it's a drawdown nonetheless. So can you talk to me about maybe what's happening right now, and then go back in time and give advisors maybe some real world examples of, how these models have successfully navigated challenging market environments like this or worse?
Yeah, I think the poster boy is probably COVID, because that really, it was very violent and fast. The COVID move down in the S&P 500 really it started the latter part of January, the beginning of February, and it bottomed in March, on March the 27th. And it was just fast and furious. And I think for your average investor that maybe doesn't look at their account every day, I mean, there must have been a lot of shocked folks out there that just how fast it was. Mm-hmm. So what the CPM model was able to do during that period is it missed about half of it. It missed about half of that move. So instead of drawing down 34, well, it was a little less than half. Instead of drawing down 34%, it drew down 20. Mm-hmm. But what that meant is when it went back to risk on, it was going back to risk on 14% better than the S&P 500. So if you do the equation backwards, it's almost like you made 14%, because you were starting from a 14% higher level than if you were somebody that was buy and hold. The other example for SEAF is in 2022, the S&P was down 19.6% that year.
NASDAQ was down, I think, 34.
Yeah, I don't know what the peak was in terms of, the peak of the drawdown, but it ended up it was down 19.6 for the year. Our CEF model was up 8.4, 8.3.
Yep.
It was in the low eights. And the way that it did that is we mentioned that it's always invested in the top 3 sectors according to our scoring system. We built an algorithm that measures the velocity of money that's moving around those 11 sector spiders. And we were in energy from January through July. And XLE, which is the energy ETF, outperformed SPY by 40% during that period. So we accumulated such an enormous lead on one ETF in the first half of the year that we kind of coasted into an 8% gain. So, and trading them both together and putting them, we have a model that actually blends both of those. You're getting that risk control on the downside from CPM, but you're also getting the opportunity if one or two sectors breaks out of the pack and really takes off. There's always that chance of being able to catch some alpha at the same time, even if the rest of the market's going down. So they do different things at different speeds. And when you put them together, it actually tamps down the maximum drawdown in the standard deviation because they kind of act as a check and balance on each other.
Yeah, the reason I brought up the NASDAQ was because that was a pretty unique year. And I've been doing this for 23 and a half years. And I remember that the S&P was down almost 20. The NASDAQ was down. It was either 24 or 34. It doesn't matter. It was not a lot. And then the bond market was down like 16% on the AGG. So it was like there was nowhere to hide. And this
Except energy.
Right. It was commodities, energy stocks. That was the only thing going up. So by, again, staying invested with the playoff teams, sometimes when you look at the playoff bracket, or not even the playoff bracket, sometimes when you look at a division, you've got a bunch of losers that are just, they all have losing records. Then you have this one shining, light in the pot. And that's the one that happens to make it happen for you. So, I think it kind of
following the money. I mean, really all we're doing very, very simply. In fact, we have a YouTube channel and it's called Following the Money because really that's all we're doing. I mean, there's a lot of math involved and a lot of back testing, but what all that is simply is we're following the money. We're not trying to play 3-dimensional chess and figure out what all of the news coming out of Washington and where interest rates are going and what's going on in the Ukraine. I think that's an equation you can't solve. And then trying to extrapolate that into a market opinion, it's great for TV, right? But it's not really good for your portfolio. We just follow the money around because the money is the smartest person in the room. It's the collective wisdom of everybody that's in the market that hasn't gone broke yet. Right. So that's the smart guy in the room, and that's what we follow.
Yeah, I think that's a good point to bring up because I think that a lot of the industry, when they think of technical analysis, a lot of people might have turned this episode off, as soon as they heard that phrase. Technical analysts are the lepers of the industry until the market goes down. Then they put them on TV, right? So it's, I think it's interesting to make sure, like what you said was really interesting because I think what everybody needs to know is it's not trend prediction. That's what the industry wants you to think. The industry, the mutual fund industry, the ETF industry, they want you to think that what we're doing here is trend prediction. We're not predicting trends. We are following them. And there's a huge difference because when you think about it, and I mean, be objective for a second here. If you're a financial advisor listening to this, watching this, if you're a mutual fund company, do you want to do research and spend money on researchers to tell people why it makes sense to sell and get out of the market? Or do you want people to stay invested in your mutual funds? Why in the world would you ever publish research that says anything other than if you miss the best 5 days, if you miss the best 10 days, what if you miss the 5 worst or the 10 worst? And by the way, there is research out there. Paul Guyer was the first one to do it. I did it again, and I think it was like 2012 or 13, I think. I did a redux on Paul Guyer's report, and I probably should do it again with all the new data we have with COVID and everything. But what I found that was fascinating is the biggest up days happen within a few days of the biggest down days. In other words, when market volatility is extremely high during drawdowns, the best days and the worst days are very close to one another. So it's really not about
bottom was just like that.
Yeah. So the point is, you shouldn't be trying to miss the best days or worried about missing the best days, and you shouldn't be worried about missing the worst days. You should be worried about missing both. You should be worried about implementing risk management, following the trends, following the money, and dialing the risk down, not on-off switch necessarily, but dialing the risk down when things get bad. So I kind of went off the rails there, but when we talk about the models, And I know we talked about how there's several of them now. We have aggressive, balanced, conservative, ultra conservatives. One of the things I think many advisors might say is, okay, this has worked in the past, but how do we know it's going to keep working? How do we know things aren't going to change? New data comes in the market changes. So how would you respond to that?
We quarterly go through all of our indicators. So, we might have 50 indicators that we're checking. And, I'm a big believer in Ray Dalio. He kind of talks about debt cycles and business cycles and economic cycles. So, we're under this understanding that just because an indicator worked last month doesn't mean it's going to work this month. Now we're not rapidly firing through all the indicators, but once a quarter we go through and we do all of our back testing again. We reconfirm that the correlations are all the same. We reconfirm that different indicators are working. I think a couple of years ago we threw out high yield corporate bond spreads because as the Fed decided to basically lock in the interest rate, that spread was no longer reacting the way that it used to react to the market, in which case it goes back on the shelf. That doesn't say that it's going to be in the doghouse forever, but, we really want to make sure that all of our indicators are firing on all cylinders at all times. The other thing we do is not one indicator is always going to work. An indicator that works 80% of the time is going to fail you about 20% of the time. So we try to diversify our indicators as well. So if we have 10 different indicators that we're trying to use to make a decision, as long as most of them are behaving in that normal fashion, we're going to directionally be correct most of the time. And it allows for indicators to go off the reservation for a little bit of time and not blow up our models. So it's a combination between diligently testing these things and understanding statistics and the fact that you can combine multiple indicators to get the outcome that you want and not have to worry so much about that 20% when they're not working.
And the bigger part of that is nobody knows what the future is going to be. Nobody does. Look at long-term capital management in the late 90s. There was 3 or 4 Nobel laureates and we all know what happened there, to the bond market. So all you could do is look backward. So I think if you look backward and you're stress testing your ideas rather than trying to put a bunch of indicators together that in 2023 made 80%, that's not what we do here.
Right.
We're looking backwards and we're looking at the stock market's a unique animal because it has an inherent upward bias. Bonds don't have that. Commodities don't have that. Stocks do. So if we can stress test our models, in this past 7 years, there's been a robust period. We've had a 100-year pandemic, and we had a major, crazy Fed-fueled move higher in 2021. We had a major downtrend in 2022. Lots of stuff happened over this 7-year period look back. So if you backtest them with the focus on standard deviation, how much activity, how much volatility is in your account. Drawdowns is probably my most important one. What kind of a hit are you going to take for having exposure in the market? If we could drastically reduce those, then looking forward, I think, again, understanding that nobody can tell the future, we're stress testing these things for bad things and letting the market do what it has done for 100 years. And that's most of the time it goes higher.
Yeah. It's and I like the whole weight of the evidence approach because I think that's often a misunderstanding, and that, if you do this, then this happens. And it's not like that, Jack mentioned the 80% thing. I mean, by the way, at 80%, an indicator that works 80% of the time is pretty awesome, by the way. But I remember one of my early mentors, Greg Morris, who I know you two know, he once told me that, you get an indicator that works about 75, 80% of the time. That sounds awesome. But if you flip it upside down and you tell them it's Russian roulette, all of a sudden it's not so fun anymore. Right. So as we wrap up here, for financial advisors looking to integrate, technical analysis, trend following, weight of the evidence approach, following the money, like we've been talking about here, let's just talk briefly about how other advisors are using these models in their practice today, either using SMAs, doing it through TAMPs, because we've been doing that this past year. And as every month goes on, we're growing fast. We've got a lot more TAMPs that we're looking at, adding these models to SMAs. We've already added those to the Schwab platform. So tell me a little bit about that. Like, what's been your experience with the advisors you've been working with so far?
Yeah, so far, I mean, what we end up doing is we talk to advisors and they give us a sleeve of the portfolio. Oftentimes it's roughly 20%, but it's give or take from there. And we, we have our 4 model portfolios, but we also talk to them about their clientele, who they're serving. And, we can kind of use the machinations of the different portfolios to create, I wouldn't say a custom, but a nice sleeve for somebody that's really going to, again, be drawdown focused, risk reduction focused. Yeah. And those advisors like it because Asbury Research is relatively consistent. Our returns are, we check returns going back over the years and the numbers stay relatively consistent as we move forward. So they take that sleeve, they can put it, it's kind of a plug and play for their portfolio. We've been doing it through TAMPs and, we have SMAs through Schwab as well. And it's going pretty smooth so far.
Yeah, the plug and play aspect of it is very good. One of our newest clients, it was almost perfect timing too. They came in with a sizable chunk of their AUM that they wanted some downside. They wanted to protect their downside. They wanted to get a defensive sleeve. So a lot of that was put into CPM. This was in January, just because of the new administration, and there was talk of tariffs and changing some of the geopolitics. The market was obviously getting a little nervous about that. So were they. So they gave us some money to manage in CPM, and they've been risk off for about a month now. And the clients, they love us, and their clients love them. So oftentimes it's a sleeve, and oftentimes it's geared towards being able to better protect at least a significant part of their total AUM.
Yeah, that makes sense. And so that's going to be our time for the day. But if you're an advisor and you're interested in maybe adding some risk management models to your sleeves or to your portfolios, to your models at your practice, if you're looking for something that maybe doesn't stay in the market all the time or follows the playoff teams, like the top seeded teams in the March Madness bracket, like we talked about, you can either reach out to me personally through this, the podcast notes. Our contact information will be there. You can reach out to John and Jack at asburyresearch.com. You can also find all 3 of us on LinkedIn. That's a really easy way to find us. But like I said earlier, if you want to have access to these models, we're already on the Schwab platform with all of the models. For any advisor that wants to plug in right now for any percentage of their clients' portfolios, they can do it yesterday. And then we're also already officially on the Amplify platform. For anybody who is using Amplify, obviously it's easy, plug and play. But if you're not, you might want to consider Amplify if you have a TAMP and you're looking at B plans, or if you don't have a TAMP and you're just looking for a TAMP. So with that all being said, thank you so much for watching and joining us today. There's a lot of good podcasts out there. You chose to give ours a listen, so I really appreciate it. So have a wonderful week, have a productive week, and we'll catch you next time.
Thank you for tuning in to the Advisors Fuel podcast. For more articles, videos, and resources, or to schedule an intro call, visit adrenalineadvisor.com. This podcast is for informational purposes only and should not be relied upon as a basis for financial or legal advice. Always talk to your compliance department before implementing any of the ideas shared in this episode.